global energy markets rarely change overnight. For decades, the structure of the oil system has appeared remarkably stable. The Middle East dominated production, Russia balanced European demand, and the United States acted as the central stabilizer of the global energy system. But the recent disruption in the Strait of Hormuz has exposed a deeper vulnerability within that structure. Roughly 20% of the world's oil supply flows through this narrow maritime corridor every day. When instability suddenly threatened that flow, financial markets reacted immediately. Oil prices surged toward levels that can quickly ripple through the global economy. Energy shocks rarely stay confined to the energy sector. They move through transportation costs, manufacturing inputs, inflation expectations, and eventually the broader financial markets. As governments began assessing their strategic options, one question quietly emerged across policy circles. If traditional supply corridors become uncertain, where can the world find reliable energy? The answer has begun pointing toward a country that has long been considered a regional supplier rather than a global energy power: Canada. With vast reserves, stable institutions, and expanding export capacity, Canada now occupies a position that few analysts fully anticipated. And as geopolitical risk continues to reshape the global energy system, a new possibility is emerging. What if the current oil crisis is not simply a temporary disruption, but the moment Canada discovers it holds far greater influence over global energy markets than anyone expected? Welcome to GeoCapitalist. Today we explore how the recent oil crisis may be turning Canada into an unexpected energy superpower, and the geopolitical forces reshaping its role in the global energy system, and how shifting energy markets, geopolitical risk, and international trade dynamics may be quietly redefining Canada's strategic role in the global economy. Subscribe for deeper geopolitical analysis. The modern energy system often appears vast and resilient. Millions of barrels move across oceans every day, pipelines stretch across continents, and financial markets continuously price energy into the global economy. Yet beneath that scale lies an uncomfortable truth. The system depends on a handful of critical corridors. One of the most important is the Strait of Hormuz. Nearly 1/5 of the world's oil supply travels through this narrow passage, connecting the Persian Gulf with global shipping routes. When tension rises in this region, energy markets react almost instantly. Traders understand that even the possibility of disruption introduces a new level of geopolitical risk. Why does this matter so much for the global economy? Because energy is not simply another commodity. Oil fuels transportation, agriculture, manufacturing, and logistics. When prices rise sharply, those increases cascade through the entire economic system. Shipping becomes more expensive. Airlines face higher operating costs. Food production absorbs rising fuel inputs. Financial markets begin adjusting expectations for inflation and interest rates. In other words, a disruption in a single maritime corridor can influence economic policy across multiple continents. But the most important question emerging from the recent crisis was not about oil prices alone. It was about reliability. If one of the world's most important supply corridors becomes unstable, which countries can provide energy that the global economy can depend on? That question increasingly points toward Canada. Energy markets are often described as forward-looking systems. Unlike many sectors of the global economy, oil markets respond not only to current supply, but to expectations about future availability. When geopolitical risk rises, traders begin adjusting prices immediately. Why such urgency? Because global oil consumption operates on an enormous scale. The world consumes roughly 100 million barrels of oil every single day. Refineries require steady flows of crude. Airlines need long-term fuel contracts, and national economies rely on predictable energy costs. Even the possibility that several million barrels could be disrupted forces markets to reassess supply conditions. This explains why oil prices can surge even before shipments are actually interrupted. Financial markets attempt to price risk before shortages materialize. But energy markets are not reacting to prices alone. They are also reacting to geography. Where oil comes from matters just as much as how much oil exists. Supply located in politically stable regions carries far less geopolitical risk than supply located near potential conflict zones or vulnerable shipping corridors. This distinction becomes crucial during periods of instability. When traditional energy routes face uncertainty, governments and energy buyers begin searching for alternatives that offer a different advantage: stability. And in today's global energy system, very few large producers combine vast reserves with political and geographic security. Canada is one of them. For decades, global energy production has been concentrated in a relatively small number of regions. The Middle East remains the dominant center of conventional oil reserves. Russia controls enormous energy resources across Eurasia. Several other major producers operate in regions where political conditions can fluctuate rapidly. This geographic concentration has long supported the structure of the global energy system, but it also creates a structural vulnerability. When energy production and transportation are concentrated in specific locations, disruptions in those locations carry disproportionate consequences. A pipeline closure, maritime conflict, or diplomatic standoff can suddenly affect millions of barrels of daily supply. This is why energy security has become one of the most important strategic concerns for modern economies. Governments are no longer focused solely on how much energy exists in the world. They are increasingly focused on where that energy originates and how reliably it can reach global markets. Countries that can provide consistent supply without major geopolitical complications become extremely valuable partners. In many respects, reliability is becoming just as important as production capacity. This shift in thinking is slowly reshaping global energy relationships, and it is beginning to highlight producers that were once considered secondary players in the international energy landscape. Among those producers, Canada occupies a particularly distinctive position. Canada possesses one of the largest proven oil reserves on the planet. The country's oil sands resources alone represent hundreds of billions of barrels of recoverable energy. But the scale of these reserves tells only part of the story. What truly distinguishes Canada within the global energy system is a combination of structural advantages. First, political stability. Canada operates within a highly predictable legal and regulatory framework. Energy investors, refiners, and trading partners generally view Canadian supply as reliable and transparent. Second, infrastructure. Extensive pipeline networks connect major production regions to refineries and export terminals. Rail systems and port facilities provide additional transportation flexibility. Third, geographic security. Unlike many major energy exporters, Canadian production is far removed from major geopolitical flashpoints. Oil shipments do not depend on narrow maritime corridors vulnerable to sudden disruption. These characteristics may appear technical, but they carry enormous implications for global energy markets. When instability affects traditional suppliers, stable producers become disproportionately valuable. Canada's energy system offers something that markets increasingly prioritize: long-term reliability. And in times of uncertainty, reliability quickly becomes influence. Energy markets are often described as price-driven, but reliability plays an equally powerful role in long-term energy strategy. Refineries must operate continuously to remain profitable. Airlines require predictable fuel costs to plan routes and pricing. Governments must ensure their economies can function even during periods of international disruption. This means buyers frequently seek long-term supply agreements with producers capable of delivering consistent shipments over many years. The importance of this reliability becomes particularly visible in Asia. Countries such as Japan, South Korea, and India depend heavily on imported energy to sustain their industrial economies. These nations closely monitor geopolitical developments that might affect shipping lanes or production regions. When instability appears, energy planners begin diversifying supply sources. Canadian crude oil, despite its distance from some of these markets, offers a valuable characteristic: predictability. Shipments originate in a politically stable country, travel through secure infrastructure, and are less exposed to sudden geopolitical disruptions. As a result, Canadian exports have gradually expanded their presence in global energy markets. During periods of uncertainty, that reputation for reliability becomes even more attractive. And it is precisely this reliability that is quietly increasing Canada's strategic importance. Canada's current position in global energy markets did not emerge overnight. It developed through decades of investment, technological progress, and infrastructure expansion. Beginning in the early 2000s, energy companies committed significant capital to expanding oil sands production in Alberta. Advances in extraction technologies improved efficiency and reduced operating costs. At the same time, new pipelines and transportation systems increased the capacity to move Canadian crude toward major refining centers. These developments occurred gradually, often attracting limited international attention. Yet the cumulative impact has been substantial. Canada now ranks among the largest oil producers in the world, with output exceeding several million barrels per day. More importantly, that production is supported by a stable political environment and long-term resource availability. In economic terms, this combination creates leverage. Leverage emerges when a supplier controls a resource that others require, particularly when that resource can be delivered reliably. During periods of geopolitical disruption, leverage tends to shift toward suppliers capable of maintaining consistent output. And in today's global energy landscape, Canada increasingly fits that description. Energy has always carried geopolitical implications. Access to reliable energy supply influences trade relationships, economic planning, and international diplomacy. Countries that can provide stable resources often gain strategic partnerships that extend far beyond the energy sector itself. Historically, many of these relationships revolved around major producers in the Middle East or Russia. However, recent geopolitical developments have encouraged governments to reconsider their energy dependencies. Diversification has become a central objective of energy policy. This does not simply mean finding additional suppliers. It also means identifying suppliers whose political systems, legal frameworks, and infrastructure reduce long-term risk. Canada increasingly aligns with this profile. As governments reassess their energy strategies, partnerships with stable producers may become more important. Such relationships can influence infrastructure development, trade agreements, and investment flows across multiple sectors. In this sense, energy supply can shape broader geopolitical dynamics. Canada's role within this evolving landscape may therefore extend beyond the export of crude oil alone. It may influence how countries think about long-term energy security. Major energy disruptions have historically reshaped global energy policy. The oil shocks of the 1970s prompted industrialized economies to develop strategic reserves and diversify supply sources. More recently, shifts in production technology transformed North American energy output. The current crisis may represent another moment of structural change. If instability continues to affect key supply corridors, governments will likely accelerate efforts to secure energy from regions considered politically and geographically stable. This could encourage new infrastructure investments, expanded export capacity, and deeper energy partnerships between stable producers and major consuming economies. Canada is well positioned within this emerging landscape. Large reserves, stable institutions, and secure transportation routes combine to create a resource base that global markets increasingly value. Whether Canada ultimately becomes a dominant global supplier remains uncertain, but one reality is becoming increasingly clear. In a world where energy stability carries growing strategic value, Canada's role in the global energy system may expand significantly. The recent oil crisis may not only reveal vulnerabilities in the existing energy map, it may also highlight where the future centers of energy reliability will emerge. And Canada is likely to be part of that conversation. The current energy disruption may prove temporary, but the strategic lesson could endure. As the global energy system confronts rising geopolitical risk, reliability is becoming one of the most valuable resources in international trade. Canada's vast reserves and stable institutions are quietly positioning it as a crucial supplier for the global economy. If these trends continue, the oil crisis may be remembered not just as a disruption, but as the moment Canada's energy influence truly emerged. And that's the real story. Today, we analyzed how the current oil crisis could be transforming Canada into an emerging energy superpower, and why this shift may reshape the global energy system. If this kind of evidence-driven analysis of global economic shifts is valuable to you, watch our next video. Subscribe to GeoCapitalist and share this with someone who still believes influence comes only from size. Thanks for watching, and we'll see you in the next video.